Granoff Chapter 8, Long-Term Debt, Part 2. Let's look at demand bonds, RANs, TANs, BANs, capital and operating leases, miscellaneous topics which include revenue bonds and overlapping debt. Demand bonds. A city financed the acquisition of equipment with bonds that could be redeemed at any time at the option of the holder. The bonds pay interest at the rate of 6%. At year-end, the prevailing interest rates had decreased to 5%. The city does not have a takeout agreement providing for refinancing if the bonds are presented for payment. So how should the city record the debt? Since the city does not have a takeout agreement, it cannot record the bonds as long-term obligations irrespective of the interest rates. It must record the debt as a short-term obligation of the general fund. So in the governmental fund, the general fund, we debit capital asset expenditure and credit demand bonds payable, since it is a current liability and the governmental funds report current financial resources. Government-wide statement of net assets. This is shown as equipment instead of capital assets expenditure. RANs, TANs, and BANs, oh my. Revenue anticipation notes and tax anticipation notes. These are short-term notes payable that are of specific streams of revenues. The state and local government needs the funds early. These are issued to meet cash needs earlier in the year. They are not converted into long-term instruments. These must be accounted for in the fund in which the related revenues are reported. Bond anticipation notes, BANs. Short-term notes issued with the expectation that it will be replaced with long-term bonds. GAAP says that BANs may be recognized as long-term obligations if the BANs are refinanced and the entity enters into an agreement that doesn't expire in 1 year, has not been violated, and is capable of being honored by the lender. Let's look at capital versus operating leases. Capital leases are financing agreements. The lessee purchases an asset in exchange for a long-term note. Operating lease, conventional rental agreements. The lessee uses property for a portion of its useful life. Governments enter into operating leases because they need asset only for a short part of its useful life. This avoids the risk of ownership, or there's an unavailability of cash or credit to purchase. Non-appropriation clause or fiscal funding clause permits governments to cancel lease at the end of each year. Accounting for capital leases, the GASB. Capital leases are treated as a purchase of an asset and issuance of long-term debt. The leased asset and related liability are accounted for like an installment purchase recorded at present value. The fund statements, we debit expenditures and credit other financing sources capital leases. That's because the fund financial statements are modified accrual current financial resources, so that's the reason we debit expenditure, credit other financing sources. Government-wide, however, is full accrual accounting all economic resources, so the capital leases are accounted for as a purchase-borrow transaction. The asset is depreciated over the term of the lease, and the general long-term liability is recorded. Revenue bonds. These are backed only by the specific revenue stream, generally reported in enterprise funds. The main reasons for issuing revenue as opposed to general obligation bonds: they provide better match of debt service costs and benefits received. Although interest rates are likely to be higher for any specific issue of bonds, they are unlikely to increase the overall risk of the entity's debt as a whole, and therefore its total interest cost. In many jurisdictions, they are a means of avoiding voter approvals and other debt limitations. Bond-related ratios. So consider these as you're working with your CAFRA entity. Ratio of debt per capita to percentage of taxable property, ratio of debt service expenditures to total general expenditures, multiple year trends in above ratios, Investors look for these ratios to assess the ability to pay and the risk of default. You can also see on this slide some information about the bond ratings. Debt ratings are of critical concern to both the issuers and investors because they may affect the debt's marketability and thus its interest rate. A bond rating service downgrade can be a traumatic fiscal event. And take a moment to look at the summary.